Ladies and gentlemen, Nvidia earnings are out, and it's a bit of a post-nut Nvidia clarity that markets now have, which is kind of a good thing. I mean, as I said, heading into this report, you were set up for not a great, risk to reward profile, right? The odds were, or the risk was, that Nvidia would fall after earnings, even if it was not a disaster. Nobody expected this would be a disaster. But the guidance is just not as impressive as what we're used to. I guess that's a good problem to have. I guess when you're such a successful company, you cannot continue to grow guidance at crazy high, rates, and people's expectations ultimately get disappointed. And that's pretty much the highlight of what happened today. So here's the earnings, okay? Revenue, $35.1 billion, up 17% quarter over quarter, up 94% year over year. That was better than expected. You were only expecting about an 84% rise in revenue. Data center revenue comes in at $30.8 billion, up 17% quarter over quarter and 112% year over year. Gaming revenue up 3.3%, up 14% quarter over quarter, 15% year over year. Automotive revenue $449 million, up 72% year over year and 30% quarter over quarter. GAAP EPS comes in at 78 cents per share, up 111% year over year and 16% quarter over quarter. Non-GAAP EPS 81 cents per share, up 103% year over year. So you have the earnings highlights here. Record revenue of $35.1 billion, driven by accelerated demand for AI and cloud infrastructure. Data center revenue reached $30.8 billion, fueled by the Hopper and Blackwell platforms. Gaming division saw strong growth from GeForce RTX and AI PC innovations, including 20 new game titles. Automotive revenue surged due to advancements in robotics and AI for vehicles. As far as the outright estimates, again, EPS was forecasted at 74 cents, coming in at 81 cents. Handsomely beat the estimates. Q3 data center revenue was expected at 29.14%, coming in at 30.8%. That beat estimates by a good margin. Nvidia Q3 adjusted gross margin was expected at 75%. It came in at 75%. So this is one slight negative. Margins did not beat expectations. With Nvidia, you kind of have to beat expectations across the board because the stock is simply priced for perfection. So margins not beating is not great. But the real reason that Nvidia is trading down about 3% right now is guidance. Margin guidance as well as revenue guidance. Full year or Q4 full year 2025 revenue guidance came in at $37.5 billion, plus or minus 2%. Okay, that was right in line with what Wall Street was expecting. So you did not beat that $2 billion, higher than Wall Street expected guidance number, right? We've been used to, Nvidia coming in at, let's say, $28 billion a quarter. Wall Street's expecting $30 billion, and then Nvidia guides to $32 billion the next quarter. It's like $2 billion on the actual beat, and then $2 billion of a guidance raise. Okay, that didn't really happen here. Okay, Nvidia kind of just guided roughly where the markets were expecting. Now, I think it's also the margin story. GAAP gross margins are actually expected to fall in the next quarter by about 2%. And Wall Street's looking around, they're going, are the good old days of 75% plus margins gone? Is this a new trend of lower margins? And what does this mean for profitability? That could be a problem. We need to see a little bit more how the earnings call goes and how the stock actually reacts after the earnings call and tomorrow morning. I think there's just a lack of liquidity or options in after hours, clearly. So Nvidia is the most heavily traded stock as far as options. So I think you're only getting half of the move or so right now, or even really throughout the rest of the day today. When we get the cash open tomorrow at 9:30 in the morning, when options start to trade, that's going to help drive this thing up again. or push it lower. But I will tell you, at least right now, it does look more negative than positive from the standpoint of what we're used to from Nvidia. Clearly, this is a great earnings, very successful company, but we were expecting a little bit more. We definitely weren't expecting, maybe margins to come down next quarter. We really were not expecting a relatively weak guidance compared to what we're used to for Nvidia. Now, there is some really good news that kind of puts some concerns to rest. Nvidia says that Blackwell demand will exceed supply for several quarters. Now, that's a good problem to have. Like, if you're going to have a problem, you'd rather have demand exceed supply, but it's still a problem. Okay, it still kind of constrains the company. I mean, let me know what you guys think down below in the comment section. Would you rather have too much demand and not enough supply, or not enough demand and too much supply, right? It's clearly a good problem to have, so I think Wall Street can look past this, but it is a problem. And for Nvidia, I mean, you're kind of priced for perfection. You can't really afford to have a problem for Nvidia. So as far as Q4 adjusted gross margin, Nvidia actually guided a little bit lower than Wall Street was expecting on the bottom end to 73%, again, as we talked about, whereas the estimate was 73.5%. The high end estimate is 74%. So either way, it is a situation of margins are going to fall for this quarter that we are currently in. Not great. Could it be worse? Obviously, but we really want to know if this is the start of a trend of lower margins. Are we just going to have lower margins now? Have we kind of peaked out on margins? Is Nvidia's pricing starting to become an issue? Maybe competition going elsewhere? These are questions that we still have, but we do have a lot of post-Nvidia clarity, if you will, to what the situation is looking like over at Nvidia. Now it says Blackwell production shipments to begin in Q4 of full year 2025. Maintains quarterly dividend at 1 cent per share. So again, I think with Nvidia, as I talked about heading into this quarter, it was never going to be a disaster, but it was likely pricing in too much good news. And that's what happened. The stock almost ran to a new all-time high right before this report. You were pricing in too much good news. Now, we got a little bit of bad news. For the most part, it was a great quarter, right? Any other business, that reported a quarter like this, you'd be up 20, 30, 40% right now. But Nvidia, no. I mean, you need blowout after blowout after blowout to get large moves in Nvidia at this point, just because we're so used to it. And that's where some of the disappointment is. So from the perspective of top line revenue guidance, it was not as strong as what we're used to. And margin guidance came in lower than expected, which again, is that a sign of just continued lower margins over the coming quarters? Are margins going to get worse? Are we at the peak of Nvidia margins? That would be problematic. If this is just like a 1 quarter issue, then I think Wall Street can look past that. We don't have clarity on that necessarily, and I don't know if we'll get clarity on that. So we definitely want to pay attention to what happens here in after hours, but I think the real move is going to come tomorrow morning when the cash open happens, when you see options start to actually trade. Because again, Tesla is the most heavily traded single stock as far as options. And that is a big driving force in the markets these days. So I think you're seeing about half of the move that we're going to get, considering the move is down about 2.5%. It wouldn't surprise me if Nvidia drifts lower. Probably down about 5% would be accurate if I were to gaze into a crystal ball and give my prediction. Now, this does not necessarily mean that the broad markets are doomed at this point, and I want to be very clear about this. Yes, S&P selling off a little bit, big tech generally selling off a little bit, but it doesn't have to spell disaster for the broader markets. You could see a scenario where the rest of the markets kind of rally in the face of Nvidia falling. It could actually be a good thing for the broader markets. The RSP did pop in after hours, kind of fell, but there's really a liquid trading on the RSP. This is the equal weight S&P. It wouldn't surprise me if Nvidia selling off could actually spark a broader rotation in our markets. So keep that in mind. Ladies and gentlemen, that is going to go ahead and do it for this video. If there is any updates, analyst commentary, or price targets, anything along those lines, or something that you desperately need to hear from the earnings call urgently, I will bring you that information when it does come out. Now, the big story today was obviously Nvidia earnings, in which we just covered. But there were other things that happened today as well. Let's mention Target down 20% today. That's a big deal for a consumer, really staple name. Now, there is some differences I will point out with Target that have me a lot less concerned than some others in the markets. Now, we also have escalating war tensions, which hit the markets early in the trading day today. It actually caused a fear bid in bonds, which I find very fascinating, and we'll discuss these two throughout the rest of this video. I will also discuss Nvidia earnings a little bit more in depth and what this ultimately means for the markets. Now, I know a lot of people are not going to like when I say this, but no matter what happens with the earnings call, no matter what happens in overnight trading on Robinhood, none of that really matters until we get the market open tomorrow morning. The stock could rally, the stock could crater tomorrow morning. I don't think you're really going to know until the markets reopen again, once more liquidity comes back into the stock. We've seen this time and time and again where Nvidia is down 5 or 10% and then ends up going green the next day. Or when the stock's up a lot, 5-10%, let's call it, and ends up going red, by the end of the next trading day following earnings. So I really don't think we'll know for sure how the markets are going to take Nvidia earnings until we get more liquidity that comes in. Now, with that said, the biggest thing I'm really watching for is how do the markets digest this? And if big tech sells off, does the rest of the markets rally? Small caps and cyclicals. Think about your Russell and your Dow components of our markets. Think about the RSP, the equal weight S&P. Do they rally if big tech sells off? That would be a very healthy sign for a broader market rally. And I would get a lot more bullish on a year-end rally for markets. Now, if big tech sells off and everything else sells off, that's a problem. Now, if big tech ends up rallying after all things are said and done, and the rest of the markets also rally, that's a great sign. If big tech rallies and the rest of the markets sell off, then you're back to that whole defensive trade yet again, and that would not be super good if you are especially a stock picker. Now let's start with some of this war news, because this is really what set the markets off today, that sent stocks trading lower and bonds higher. So you actually got a little bit of a fear bid that came in. This happens when there's geopolitical issues, when there's a problem, right? You tend to see the bonds do well. You tend to see investors buy bonds and drive down yields during times of fear and uncertainty. You've seen this like during COVID, right? Bonds went up crazy during COVID. It didn't last long because people realized, oh, it's probably not going to be as bad as we think. And then bonds ultimately came down and yields went up again. But today you did see a bit of a fear move in bonds, which leads me to believe that this war escalation situation is probably not over with. Now, the news today says that Ukraine fires British missiles into Russia. These are Storm Shadow missiles. So the news yesterday was Russia changed their nuclear doctrine to say, and I'm going to simplify this here, if a country attacks Russia with the direct help of a nuclear country, that is the equivalent of being at war with that nuclear country and could allow Russia to use nuclear weapons. That is essentially the change of the doctrine, the nuclear doctrine that you had yesterday. So this has the markets a little concerned about continuing escalation of these war tensions. And again, if it spills over into something larger, then that's where you have a problem. But at this point, I don't see a larger conflict. I don't think other countries are going to get involved. I don't think Russia's going to attack other countries, especially with Trump coming back into the White House soon. And there was also news earlier today and last night that Trump and Putin already are discussing potentially ending the war in Ukraine. Anyways, Putin's kind of putting his path forward ahead that Ukraine can never join NATO, things like that. So I doubt we get a larger conflict, at least from Russia's part, before Trump takes the White House. And I see that as especially less likely afterwards. So should you be concerned about this from an investment perspective? I think no. Absolutely not. Now, just to skip to something that I think is important to pay attention to, because obviously Nick Timiraos tweeted it. Markets pay attention to what Nick Timiraos says. Before we get into this Target situation, Nick Timiraos writes, Fed officials continue to keep their options open. Fed Governor Lisa Cook maintains a fairly optimistic view on inflation and the economy more broadly. She lays out 3 potential policy paths in the following order. Number 1. Quote, if the labor market and inflation continue to progress in line with my forecast, it could well be appropriate to lower the level of policy restriction over time until we near the neutral rate of interest. Number 2, however, if inflation progress slows and the labor market remains solid, I could see a scenario where we pause along the downward path. Number 3, alternatively, should the labor market weaken in a substantial way, it could be appropriate to ease policy more quickly. So really, that's the definition of leaving the door open to anything. Okay, you are handicapped to the economic data. If the data gets worse, you get more cuts. If the data continues to kind of come in line with what we've seen recently, you get no cuts. If inflation falls faster than expected, economy slightly weakens, you get cuts. At least the Fed's making it crystal clear what the markets should expect. Now, it was also reported a couple of hours ago from Europe Invasion on X that Russian forces are preparing to launch the RS-26 intercontinental ballistic missile weighing 36,000 kilograms with a range of 6,000 kilometers in a possible attack on Kyiv. Now, that seems like overkill for an attack on Kyiv, and I think markets are concerned what this could lead to. If it could have a warhead attached or something. I think markets are kind of fearful underlying this escalation in this Ukraine-Russia war. I just don't think anything is dramatically going to change nor get worse here. It just doesn't seem likely before a new administration takes office. Target reported earnings this morning with EPS of $1.83, missing expectations of $2.30, revenue of $25.2 billion, missing expectations of $25.7 billion. Target lowered its full-year adjusted EPS guidance to between $8.30 to $8.90, down from between $9 to $9.70. Target got punished, to say the least, off of this earnings report. And it has a lot of other names that have nothing really in common with Target, like Dollar General, like Walmart, to sell off in sympathy as well. And again, this is kind of hitting everything, not just your big box, retailers, but it's hitting everything at least slightly that has to do with the consumer, because people are saying if Target's struggling, then maybe other consumer companies are struggling. I don't think that makes any sense at all. Just, my example here. I buy a lot of toothbrushes, right? I like to keep a clean toothbrush. I don't like to keep it for too long. I always get them at Dollar General. They're $2 a piece. No big deal. Well, went to Target today, and the same exact toothbrush that I get at Dollar General for $2, $2.50, something like that, was $9. $9. I said, yep, not buying that. Okay. There's just there's a problem with that, right? You're only going to sell so much if you're a higher priced, product. That's where Target should make up for it in margins. If they're selling, items that cost more than like a Walmart, right? They should have a higher margin per product that they are selling. But clearly that's not happening, or it's not happening enough. And I'm not concerned about these earnings at all. I don't think this has any implication for the broader consumer. Literally none at all. Zero, zilch. Okay. Look at Walmart's earnings. Those are the ones that are really important. And Walmart raised their full year guidance, 4% year over year comparable, sales growth. Now, I don't believe that was inflation adjusted. So I think inflation adjusted, it would be more like 2%, right? Maybe 1%. But still, I mean, there's a big difference between what's going on with consumers at consumer, staple like companies. Companies that are offering good prices are getting business. Companies that are not. And I think that's just the way it goes. Like, think about Elf today that had a short report out. By far the worst short report I've ever seen. It just doesn't even make logical sense to say beauty trends are collapsing at Elf. That's ridiculous, right? Beauty trends do not collapse. If you're a female, I'm sure you understand that. When you find something you like, you tend to stick with it. Okay, I've never used makeup a day in my life, but I've known a lot of females that are that way, right? Nonetheless, not to deviate from the point I'm trying to make here, but like Elf sells cheap products. They've been doing well. Okay, fundamentally that is a lot better than Estee Lauder that sells, very, very expensive higher end products. Who's the clear winner there? It's obvious. It's Elf. Okay, and that's kind of the same trend for everything right now. The consumer's not in a good place. They're buying what they need to, but they're very conscious on price. These multitude of different factors today, obviously Nvidia, Target earnings, war escalation, the Fed today did have a pretty dramatic impact on markets. And I expect you'll probably get an even larger impact to markets, coming over the next couple of days. Now, clearly Nvidia could bounce, Nvidia could rally. I don't think we're going to know again until more liquidity comes in. So I would really take any moves that you see here with a big grain of salt, and just keep in mind what we talked about throughout this video. With that said, ladies and gentlemen, enjoy the rest of your day, and I will see you in the next one.